Welcome to the Flippin' Finance Show, your source for empowerment and education on financial literacy, entrepreneurship, and real estate investing. My name is Mario Cabral. I'm a licensed financial advisor. I'm with my co-host,
Daquan Carr, the hard money lender for everything real estate.
And I know the last few podcasts, the last few episodes, we've been talking about, more about mindset and motivation. I know a lot of you guys been waiting for like the knowledge and about stocks, bonds, all these other wealth topics. We had to let you guys get the mindset first.
We had to do the intros.
Exactly. Because wealth is a mindset. You got to get that mindset right first before you could, take in these informations where you could actually implement it. Because I could, tell you about where to invest in the stock market, but if your mindset isn't there, then you're just gonna listen and not really take action on it. Would you agree?
Yeah, that's 100%. Obviously, some random dude tell you, yo, you should stop wasting your money at buying shoes. You should invest in the stocks. You're like, man, get out of my face, because obviously your mindset ain't where it need to be.
Exactly. So we got a pretty good topic that I love. We're really gonna talk about life insurance and the benefits around life insurance and how that could be used to create generational wealth. Because generational wealth, that gets thrown around a lot. Everyone says they want to create generational wealth. Hey, I want to create generational wealth. Yeah, that sounds nice, but when it comes to life insurance, people are overlooking on how they could use that to create that generational wealth.
Yeah,
when most people think about generational wealth, they think about creating that for themselves. Yeah. Like that doesn't make sense. Like you have to think about the next generation. That's how you create that.
Exactly. It's not about today. Pretty much, generational wealth has nothing to do with today.
With you,
today. It has to do with once you're gone and what that money doing after you're gone.
So life insurance, man. Honestly, I have a 401k. I invest in a 401k. I have a couple brokerage accounts where I buy and trade stocks, mutual funds. I have a Roth IRA as well, another retirement account. But this right here is my favorite, life insurance, because I generally because I know that's a big tool for me to be that spark in my family to create that generational wealth. Like I want my great grandkids to really think back and be like, yo, shout out to my great grandfather. He really held it down for us. That's why we're all eating right now. Like I want to be that person.
Yeah, definitely. Same. I know, like right now, I know you're gonna get really into the life insurance, but to me, I think life insurance is the easiest way. Like out of everything that you can do to build generational wealth, life insurance is I believe is the easiest. It's literally just paying a premium and just living your life on it. You don't have to worry about it as long as you make your payment. That's how I feel.
Yeah, and when it comes to building wealth, building wealth is through generations. Like you're not gonna be an instant millionaire. That's most cases you're not. Like that's just a sad reality. Unless you're basketball player, NBA player, rapper. Those are those case by case scenarios.
Yep.
But in most cases, regular people like us, you're gonna build that generational wealth, through generations. Each generation building on top of the other. Mm-hmm. So that's what life insurance pretty much allows you to do. And honestly, there's a big racial wealth gap right now. Compared to black and brown people with whites. So pretty much how that gap was a thing was obviously slavery. If you have America's built on the backs of slavery, slaves and stuff. So pretty much white people profited off free labor, basically.
Yep.
That's how they created their wealth. If you have a business that you don't have to pay your employees, that's instant.
Yeah.
That's instant profit right there.
Yep, like sweatshops and stuff like that. Yeah.
Exactly, because when it comes to running a business, you're paying your employees going to be your most number one expense. But since America didn't have that expense coming up, that's how white people pretty much gained from that. Yeah. So slavery obviously set us back economically. Real estate as well. I'm not too knowledgeable about what exactly redlining was, but can you just explain real quick what redlining was?
So obviously there's a great video that's out there that explains it. It's pretty much banks wouldn't first off lend to people of color, even though we met all the qualifications. Segregation was still a big thing. and they would pretty much have white only areas and only lend to white people. So they were able to buy up all that land that was out there. So once they were able to buy it all, they would pass it down from generation to generation. So we would only have to be able to pretty much rent it. We didn't own the land. So that means their kids would just, probably even to this day, they're just benefiting off of their great grandfather that owned 4 acres of land somewhere, and that's pretty much what it is. So now we were pretty much behind, and now obviously we have the opportunity a little bit more to catch up, but even though we have to work harder to catch up because they're already 3 steps ahead of us.
Yeah, they're hundreds of years ahead of us. Yeah. So you have that, and then you also have life insurance. Pretty much same scenario. Back in the day, life insurance was not given to black and brown people. Like you can apply for a life insurance policy, like if you were black. And life insurance is a good tool to pass down a large lump sum of money to the next generation. So pretty much white people, they had that advantage of owning real estate and life insurance to pass down assets to the next generation. So that now that pretty much built that racial wealth gap. So we pretty much don't leave inheritance to our heirs, and that's not because of it was our fault, but it's because America just had a lot of systems in place where we couldn't strive and we couldn't really take the steps to progress in life and level up financially. So that's why there's like a big racial wealth gap today. But life insurance, that's definitely something that you could tap in, now to, at least start that spark in your family and in your generation to build and pass down wealth. So
that's why I said it was. I think it's the easiest. It's I wouldn't say free money. I would say you're paying a premium, but still, it's the most simple. I think it's a lot easier to explain and a lot easier to get into.
So with life insurance, like you mentioned, you're paying your premiums a month, but you're pretty much paying pennies for dollars because the amount of premium that you're paying over the life of the policy doesn't even compare to how much you'll receive how much your family will receive as that death benefit. So let's say you're paying $100 a month for a $500,000 policy. Let's say you started let's say you're 30 years old and you were paying that for 40 years, and you pass away in your 70s, or let's say. For 40 years, you're paying $100, so that's $48,000 a year. So you're pretty much paying $48,000, so your family could receive $500,000. So like you're pretty much
spread out. I think you said over a year. That's 40 years. So you're paying $48,000 total for the rest of your life until the day that you die. So and then you're gonna get that $500,000.
Yeah. So you're pretty much buying money in a sense. So that's why I love life insurance. So it's just one of the easiest ways to pass down wealth, and pretty much one of the main reasons on top of passing down a legacy to your heirs. Was that how you pronounce it? Heirs?
Yeah, pretty much. Yeah.
So why would you need life insurance? Because obviously there's ongoing expenses and there's immediate expenses as well as to that will be left to your family. So obviously the first one that comes to mind is funeral expenses. Funerals aren't cheap. Funerals will range from $7,000 to $12,000. So I know there's a lot of people that lost their loved ones and they were forced to collect the funds for a funeral via GoFundMe. Yeah. Me personally, I don't want my family to having to use that platform to collect money. I don't even want them to ask in anybody else for money to pay for my funeral expenses. I'd rather just leave them money behind where they could, use that money that I left to pay my funeral expenses. So you got funeral expenses. Now you also have, other debt that you left behind. Those don't go away just because you passed away. Mm-hmm. A lot of people, they don't even realize that your debt gets passed down to, whoever, your family. They're going to be responsible for
somebody still got to pay that mortgage if you plan on still living there.
Exactly. So you also might have student loans, maybe some credit card debt, business debt. Like I said, those don't go away. So a life insurance policy, that goes for your family. So they could use that money to pay for your funeral expenses as well as any other debt that you left behind. Now, also, a lot of people, they also have, maybe they want to put their kids through college, and you wanted to use that life insurance policy just in case that you passed away before you were able to put them in college. They could just take that money from the life insurance policy to pay for those 4 years of college. So, for example, let's say like there's $20,000. That's how much it'll cost a year to put your kid through college. So 20,000 times 4, that's 80,000. So then you would add an extra $80,000 on top of your life insurance policy to, cover that in case you passed away before, you were able to put your kid to college.
Yeah.
So there's that. Now you also have ongoing expenses too. So everyone grieves different. Let's say you had a spouse and you passed away. Your spouse, he has a job. Now he's going to be left with, dealing with that emotional trauma, mental, trauma, obviously grieving over a loved one. So pretty much you have transitional income to leave behind for him in case, he didn't want to go back to work the next week or the next month or the next year. Everyone grieves different. Everyone has their own process. Some takes longer than others. So that's just money for them to live off of until they're ready to get back on their feet and, go back into the workforce. And then obviously, income as well. Let's say you're the big breadwinner in the family. If you pass away, there's no longer income coming in that you would have brought in if you were still alive. So they're depending on your income, your family. So, the life insurance also covers that in case you pass away. You pretty much their family will be pretty good with.
Yeah, they won't have to, figure out how to pay these extra bills, like cable bill, all those little expenses that you're taking care of. They're like, oh, I can't compensate for, I'm only making $30,000-$40,000 a year. All of that doesn't cover our overhead that we have now. But if you pass, obviously, and you leave them that hefty chunk of change, they won't have to feel stressed. They won't have to take on a second job. They can be like, okay, I got enough time to figure out what I need to do to live off of just me now.
Mm-hmm. Exactly. So you definitely want to make sure that you're leaving your family behind in a better situation, not a worse situation when you pass away. There was a meme that I seen on Instagram. It said people that don't own life insurance should, like, once they pass away, they should come back and see the mess that they left behind. Yeah. Like I seen that, I was like, wow, like that's crazy because a lot of people leave a lot of debt behind. Like you came into this earth and then you left your family in a worse situation.
With everything that you had going on, obviously everything is good now because you still got that job like you mentioned, so you can pay for all the bills. You're still paying your credit card bill on time, but life happens quick. So boom, one day you're gone, and now you thought you had enough time to pay that stuff back, and you realize that, oh snap, I don't, and you don't have life insurance. So now you don't really think about it because you're like, I'm gonna be here forever, so I'll pay that. I got $20,000 worth of credit card bills. I can pay that. I'm gonna be here for another 10, 20 years minimum. I can pay that back no problem. Mm-hmm. But then life happens, and then you realize it's too late. Because trust me, I don't think they're gonna give you life insurance on your deathbed. So make sure you get it now.
Yeah, and I know there's a lot of young adults listening to this podcast, and they're like, okay, that's nice and all. As to why we need life insurance, but I don't have any kids. I don't have too much debt to leave behind. I don't really need life insurance right now. Well, I would definitely disagree with that because the earlier you get life insurance, the cheaper. The cheaper it is going to be for you.
Way cheaper.
Because life insurance, the cost of life insurance is based off your medical history, your health, your age. So pretty much how likely you are to pass away. Yep. So, if you have a good health history, you don't have any underlying illnesses, diseases, you're pretty young, you're gonna have a good rating when it comes to life insurance. So when it comes to how they evaluate you, the insurance company, they give you a rating based on how healthy you are. So you want to make sure that you're getting life insurance as early as possible because you can lock in that rating, and then you keep that rating throughout your whole life. So let's say they gave you the best rating at a young age. At your young age, you're generally more the healthiest part of your life. So let's say you got the best rating possible because you got it at a young age. Let's say the next year you were diagnosed with cancer for some reason. They can't take that rating away from you. Yeah. So you lock in that rating. You lock in your insurability, as we say, like in the industry. Yeah. So now, like, even if something happened with your health, you're good because you locked in that rating when you were healthy.
Yeah, so, that's why I just said, like, I don't think they're going to give you, life insurance on your deathbed. Nah, I'm saying, like, when you're at the hospital at your worst moment, you can't just call them and be like, hey, I'm looking for, some life insurance. They're going to be like, all right, explain your situation. You'll be like, well, currently I'm in the hospital right now. They're going to be like, click. Cool. They're going to go right on you.
Do. Yeah. Like an iPhone. Yeah. Do. But,
they're going to hang up right on you.
But yeah, so I'm actually glad that you mentioned that because life insurance companies, they want to give life insurance policies to healthy and young individuals. Yeah. Like that's pretty much, how they make their money. They bet on people who's gonna live a long life.
Time, yeah.
Exactly.
So I think we did the math, right? So let's just say you pay, obviously it'll probably be a little bit more if you get it longer. I think we said like 48,000. So let's say you get it like young like us, you're probably end up paying like closer to 60. So they're already backed by banks and stuff that they have the funds that they're going to pass out anyway. So they are just chopping it down like, all right, 60 grand. I know we're going to get that from this guy because he's young and healthy. So they use that, start funding other stuff. And so and it equals out over time, stuff like that.
Yeah, it's kind of like a win-win. Like if you're healthy and for the win for the insurance company and win for you as well.
Yep.
Because obviously they get a more years of premium. Let's say if they gave it to someone that was unhealthy, and they passed away the next day. Now they only got like, let's say $100 throughout that whole throughout the contract of life insurance policy. Yeah. But then they also have to give that death benefit. Let's say it was $100,000. They have to give that to their family for the person that passed away.
Yeah.
So they pretty much lost $500,000, and they ain't even get premiums enough to like invest in, flip it basically. So they want us to live a long, healthy life. And there was another thing that I seen on YouTube where it said, do Black lives matter? Absolutely. Do Latino lives matter? Absolutely. But they'll matter a whole lot more if we had life insurance policies.
Yep.
Because the police are killing us and stuff, but if we all had like a $500,000 life insurance policies, the insurance companies will tell the police officers, yo, stop killing these people because they're costing them money.
Yeah, you're paying a lot. Yeah, every time you do that, that's $500,000 out of my pocket. Obviously, they don't care. They're like, well, he didn't have life insurance with us or anyone we know. So it's like, all right, our funds are still coming into who they need to come to.
Exactly. So, the life insurance companies will definitely be an advocate for us.
Yeah, that's a big one right there. That's a big gem.
For real. But so the next reason why, even if you are young, why you should get life insurance is because, you want to make sure that you're getting that early, and then you could leave, money in for your family as a legacy. Yeah. Build that generational wealth.
Yeah. So what you said, I'm pretty sure that's what I figured you was gonna say about the generational wealth. I would tell everyone right now, if you're young, and even if you don't got kids, just get it, because like we mentioned before, it's going to be cheaper. Like maybe you plan on having kids when you're 30, in your 30s, but if you plan on having kids, you got kids in your 30s, then instead of you paying that, let's just say $60 or $40 a month, now you go there like, okay, I need to get my stuff in order now. Now you're going to be in the 120s or 140s, like the 3 digits, instead of you just having it now and just paying that cheap premium now.
Yeah. So I know there's a lot of you guys still listening to this and like, all right, that's still cool and all, but I still want to benefit from it while I'm still on this earth. Yeah. You can absolutely do that in a life insurance policy because with a certain type of life insurance policy, it could be that protection for your family, but it can also be used as an investment vehicle as well. So pretty much just to break down life insurance. So you have 2 types of life insurance. You have term and permanent. So term insurance, think of as temporary. So you pretty much have a start and an end date. So it expires at one point. So let's say you could take on a 10-year policy, a 15-year policy, a 20-year policy. I've seen as long as 30-year policies. So let's say the death benefit is 500,000. So the death benefit is how much your family will receive in the event that you pass away. Uh, so beneficiaries is who receives the money, your family, whoever you name beneficiary. So term policy, start and end date. So let's say you passed away, you took on a 10-year term policy and you passed away year 7. Then your family will receive that death benefit. Now, let's say you took on a 10-year term policy and you don't pass away in that time period, then your family does not receive that money. So keeping that in mind, term policies pay out on average like 2 to 3%, meaning that term policies aren't paying out too much because more people often than not are living past that time period. So, for example, like myself, what are the chances of me passing away? Let's say I took on a 20-year term policy. I'm 23 years old. Let's say I take that on. What are the chances of me passing away at age 43? I'm pretty healthy, so it's not too likely.
Yeah, definitely.
So that's why these plans don't really pay out too much. It's mostly geared towards if you wanted to cover a certain type of debt. Let's say you had a 30-year mortgage and you wanted to have a 30-year term policy in case you passed away before those 30 years, before your mortgage is paid off. Your family could just use that life insurance policy to pay off the mortgage. That's a good, plan for a term policy. Or if you had kids as well. And let's say you had a newborn and you wanted to take out a 25-year term policy in the event that you passed away before they reached the age of 25, where pretty much, at 25, they'll be out of the house. They probably have a job and they can fend for themselves.
Yeah. So what you're saying is, term policies are more of situational type of stuff. Like you have certain things, like you mentioned, like new kid, like, all right, just in case something happens, I want to make sure that during this period of time they're covered. And as long as even 25 years from now, okay, I know they're all set. I don't need that term policy no more. Or I got this 30-year mortgage now, so I know that my mortgage is going to be paid for just in case something happens before I die. And I know you probably didn't go over this yet, but you can have more than one different type of life insurance policy.
Absolutely.
Right?
You can have a bunch of policies. You can have a mixture of both term and permanent. I'll get into permanent in a minute, but you can have numerous types of life insurance policies. You're not limited to a certain amount because the insurance company know that everyone has a lot of different situations, and these different types of term policies and permanent policies are necessary for each individual situation. So for every life insurance policy, there is something called the cost of insurance. So the cost of insurance is what it actually costs the insurance company to provide that death benefit for your family. So that's what it actually costs them pretty much. So let's say the cost of insurance in a term policy, because these term policies don't pay out too much and it is pretty cheap. Let's say it is $50 a month. Now your premium is also going to be $50 a month. So your premium is how much you're actually paying into the policy. So how much is actually getting drafted from your bank account. So in a term policy, the cost of insurance is always going to equal the premium because all you're doing is pretty much, just getting pure coverage. You're not doing anything else. So that's pretty much term insurance. Now, for people that are looking for more of a permanent plan, then they'll go towards permanent insurance. So with permanent insurance, you're covered for your whole life. So since you're covered for your whole life, then let's take that same $500,000. Your beneficiaries are 100% guaranteed to receive that $500,000 because obviously no one lives forever. So since you're covered for your whole life, then the insurance company knows that at some point they're going to have to come out of pocket $500,000 to pay your family in the event that you pass away. It's a matter of when you pass away, not a matter of if, like in term. So with that being said, it is going to be a little more expensive because the insurance company knows that at some point they're going to have to come out of pocket. So let's say the cost of insurance is $100 a month. Now your premium isn't going to be $100 though. Let's say it's $300 a month. Now, obviously, you're paying $200 extra over that cost of insurance. You're probably thinking, all right, why am I paying extra when I only need to pay $100 a month into the policy? So that extra $200, that's actually going into a cash account for you that builds something called cash value. So pretty much how the cash value grows is it can grow in two areas. It could grow in a fixed environment where pretty much the insurance company, they're gonna take that $200 and they're gonna invest it for themselves in their own account. So they're gonna take on that risk of investing it for themselves, and then they're gonna credit you usually 2 to 4% as PCs, kind of like off their profits, kind of.
So let me ask you this. So you've mentioned that it's $100 policy, but you probably have to pay $300. So how did that determine? Why isn't it? I think you mentioned it a little bit, but break it down for us in more detail. Like, all right, they say you pay $100 that goes to your life insurance, but why?
Why is it 300?
Why is it 300? Yeah.
So it's pretty much based on how much you want to fund it. Like it's based on you. A lot of people think that, these plans, life insurance policies are pretty flexible. Like if the cost of insurance is $100, you can put in as much as you want. You can do $100, or you could do anything, over that. You could do 150, 200, 250, 300. It's pretty much up to you and how do you want to build that cash value. Obviously, if you put in more over the cost of insurance, then that cash value is going to grow faster because more of a portion is getting invested for you. So for example, let's say the cost of insurance is $100, but you're only putting in $150. Only $50 is going to be invested versus if you put in $300, $200 is getting invested. Does that make sense?
So what you're saying is if I put in more, they're going to invest it for me and then I can use that money whenever, pretty much, right? Is that what you're saying?
Yeah. So when it comes to, building out that cash value, like I mentioned, you have that fixed environment where the insurance company, they're going to take that $200 and they're going to invest it for themselves, and then they're going to credit you 2 to 4%, as interest fixed every year. So pretty much how that grows is going to be slow and steady. So if you look at a chart, it's going to go up, but slow and steady. Now, if you wanted to take on that risk yourself for that higher return, then you'll go towards a variable policy. Oh, so one second before I talk on the variable policy. An example of a fixed environment, of a cash value growing in a fixed environment, is a whole life policy. You might have been familiar with that. Universal as well. So back to the variable policy. The reason why it's called variable is because the cash value is going to vary throughout the years, because the $200, you're going to take on that risk, and the insurance company, they're going to take that $200 and they're going to invest it for you for your own account on your behalf. So that's going to be invested into the market and all these different stocks, bonds, mutual funds, all these different funds out there. So it's going to grow the same way that a 401k or a Roth IRA grows. So obviously, if you have a 401k, if you have a Roth IRA, you know that every year, is going to pretty much fluctuate in the growth.
So when you say, all right, my regular payment is $100, you can just put $100 if you want to, right?
Mm-hmm.
And you be like, I don't want to pay no extra. And I want to invest in myself, or I just want to use my extra money that I have for personal stuff. You can just pay your regular premium and just be happy with that, right?
Yeah, exactly. Okay. But most people they love that idea of that cash value. They want to grow it over the years. So you definitely want to make sure that you're putting more into the plan so that you could build your cash value faster. So with the variable policy, like I mentioned, you could pretty much see a rate of return between 2 to 12%, because that's actually going to be invested into the market, versus a fixed environment. You're going to see a rate of return between 2 or 4%, because you're gonna know that you're getting that fixed every year. That's pretty much guaranteed. Versus a variable policy, you're gonna take on that risk for that higher return. So you don't know. One year you could get 7%. The next year it could be 1%. Pretty much based on what the market does. The market is unpredictable. So that's pretty much what it's based off of. But over the years, if you look more long term, variable policy, that's somewhere where I personally lean towards, because I am young. And, if you look at investing in the long term into the stock market, that the stock market is gonna do what it does. It's gonna go up and down, but pretty much throughout history it's been, going up.
Yep.
Yeah, because the economy is always growing. Think about how the economy was 100 years ago versus today. Our economy now is 10 times better than how it was 100 years ago.
Yeah. So I got another question for you. So if I'm just a regular person, right now listening to this podcast, I'm pretty sure you'll cover it, but I just can you give us a breakdown of from start to finish? Like, all right, I need to get life insurance. They telling me that I need life insurance, so let me just figure out where should someone start to get life insurance? Pretty much.
Pretty much just shop around. Basically, just look at all these different companies out there. There's millions, or not millions, but there's hundreds of life insurance companies out there. So, pretty much think about how much you would like to leave behind for your family. Let's say you have a certain amount that, even if you don't have kids, me personally, I have a $500,000 life insurance policy. I don't have any kids, but I know in the future that, hopefully I would have kids. So, let's say, when I do have kids and I do pass away, then my kids will receive that $500,000. So I'm kind of planning ahead.
Yeah, and obviously, I think we talked about this in the beginning, and now you're paying that low premium instead of waiting to be like, all right, I don't got kids yet, so let me just wait for it. And now you're paying, like you mentioned, pennies on a dollar.
Exactly. So it's pretty much based on like what do you want in life, basically. What do you want to leave behind? And how much, and if that cash value is something that you really care about. Me personally, I care about that as well. I want to leave something for my future kids. Even if I don't have kids and I pass away before I have kids, that life insurance policy or that $500,000 is going to go to my two sisters. So, you can always change whoever receives the money. So it's not like it's locked in.
So let me ask you, we'll jump back over to the cash, the cash value portion. How does that work? Like, so say I'm putting in an extra, my policy is $100. I want to put in an extra $100. Do I have to wait a period of time before I can be like, can I get a loan? Or that's how they do, they would give you a loan or something like that, right?
Yeah. So, I mean, you do want to make sure that your cash value has built up a decent amount before you take away from the plan. It's more like a midterm kind of bucket of money that you want. So one thing I didn't mention about the cash value is that you can use that for a lot of different reasons. You could use it to pay your premiums. Once it's built up to a healthy amount, you can use that to pay your premiums every month. So now you pretty much have free life insurance. Okay. You can also use it to take out tax-free distributions from it. So let's say you want to take out $20,000 for a down payment on a house, tax-free. You could do that. You could use it for a new vacation, a new car, invest it to your business. You could use it to supplement your retirement income, tax-free. So it's a lot of benefits when it comes to that cash value.
And do you have to pay that back, or if you're all set?
So you can either pay it back. So basically it would be a loan, or you can not pay it back and it'll just be reduced from your death benefit.
Okay.
So yeah, you can pay it back, or you cannot pay it back. So it's pretty much up to you. So a lot of different tools when it comes to how to build wealth with life insurance. So
I know we talked about this briefly on like you can have different life insurance policies. So so should you have like a term and a permanent one at the same time, or should you just like, well, $500,000 is good enough for, that's pretty much like a normal number that most people will get, like 500,000. How would you break that down to someone asking like, what do you really get?
Yeah, like getting on a combination of term and permanent is always key, because when you're going through a life needs analysis and you're looking at all these different, expenses that will need to be met in the event that you pass away, or, how much you would actually want to leave behind. A lot of times it's like, $1 million. So $1 million of permanent is going to be very costly. But if you could combine that with term insurance, then it brings the cost down. So it's definitely a good idea to have a combination of term and permanent, just to, find that best fit for you, find a policy that is around your budget. So that's another thing. A lot of people think that life insurance is just costly, period, and it's very expensive. It's not at all. It's based on your budget, based on what you want to do.
Okay, so I think you just said, like, if I want to leave $1 million for my spouse, family members at XYZ, probably don't take out that $1 million life insurance, because it's gonna be like, ooh, $1 million, your premiums are high. So should I just take out a $500,000 from this place and the $500,000 from this place, and it'll pretty much be a low cost? Or should I just be like $1 million from one place, and that's one place you got to do it from?
I mean, I don't think it's gonna be like, I think the cost is still gonna be the same if you do the same type of life insurance policy. with one company and then do like half here and then half over there if you're doing the same type. But let's say, for example, let's say if you want to leave like $500,000 for your family, that's something that is that's pretty much permanent. Like that has to be permanent insurance because you're gonna have to pass away in order for your family to receive that amount. Okay. But other things like college expenses, that could be like a term policy. Mortgage, debt repayment, that could be another term policy. Any type of policies or debt that has a start and an end date.
Okay.
That's where you can incorporate the term policies. But if it's something that like funeral expenses, if you know that you need money for funeral expenses, that's gonna be part of the permanent as well.
Okay, yeah. So that makes a lot of sense and a lot of information, obviously, that I just learned from that as well. And then one more question is, so let's just say, obviously a lot of people listening like, I'm gonna get life insurance, but obviously they're not gonna take it like today or anything like that. They're like, I'm gonna wait, forget about it and then move on to it. If you were to really explain, like, I know we talked about cash, like even I want to know, like, what can I do right now so that way, within a few years or so, I can build up, an amount thing like a cash value where I can start pulling it out. Should I just start like open up a term one and then paying more into it and then pay it like that?
So with term insurance, it is cheap because one, it has a start and end date, so it expires at one point. You also don't get your refund back or any premiums back if you don't pass away in that time period. Also, there's no cash value built in a term policy. So you can't build cash value in a term policy. That's why permanent is, to me, that's where it's at. Because you could build that cash value and, once it's at a healthy amount, you could withdraw for no cash value, tax-free from anything that you want. So it adds that protection for you, for your family, but that also has the investment side as well. So it's kind of like best of both worlds.
Okay. Yep. So that's pretty much all I got. Is there any other like secret gems that someone that actually do this every day? What could you say? Like, hey, there's some secret gems that you got.
I mean, for young individuals, I would say, even if right now you don't really want to build the cash value right now, but you do still want life insurance just to like have it right now and lock in that insurability, I would say. And lock in your base rating if you don't forgot what insurability means. If you want to lock in that best rating, I would say take on a term policy because it is cheap, and it's going to be even cheaper because you're young. So take that term policy out, and then you could always convert it into a permanent plan. Whenever you feel like the time is right.
Okay.
And then you could put more into it and build that cash value. So I would say that because obviously being that we're young, a lot of us are broke. And
so what you're saying is a term policies is probably only a couple dollars, right? And let's just say you get like a 10, 20 year one. By that time, we're all, you're old. Your life is obviously moving. Yeah. So what you're saying is get it now cheap. And then when you realize that, okay, I'm finally making some money where I can spend an extra, $40 a month or something like that, then move to the permanent. Now, when you say that though, do I have to do that before it expires, or can I come back like, oh snap, 10 years just flew right past me, I ain't even converted? What will happen then? Will I have to start from scratch?
Exactly. So you have to convert it before the policy ends. So, if you have a 10-year term policy, you have to do that before the 10 years and convert it into a permanent plan. So the neat thing about the conversion is that you transfer over that rating into the permanent plan. So even though you took on the policy 10 years ago when you were like, let's say 23 years old and you were very healthy and you have that good rating, and you converted that into a permanent policy and you're at age 33, it still transfers that best rating that you got, it transfers over to that permanent plan. So, you're still paying like a pretty low expensive premium and things like that. So what was it? The second question, what was it?
I think that was it. If it ends and
so if it ends and you don't convert it, then you have to reapply for life insurance. So obviously you don't want to do that because now you're applying while you're old and maybe you've developed some illnesses, some diseases or whatever, and now you're even more at risk of getting a lower rating where your where your premium is going to be a lot higher. And yeah, so definitely if you're going to convert it, definitely convert it before the policy ends.
Okay, so my last question is, one thing that I know, because obviously I have life insurance, is you have to get well, at least I wouldn't say have to. A lot of them require you to go to the doctors, and do like their evaluation thing to determine that. So that's why they force you, pretty much not force you, but tell you go while you're young, while you're healthy, because even though, like I said, you're on your deathbed and you realize that you got cancer, you're not going to be able to pull a fast one on them, because they're like, all right, now we need to go to the doctors. We need you to see, do all this X, Y, Z, all the stuff. And then they're going to get their report, and it's going to say, oh, he has cancer. He got arthritis in every knee. He got all type of stuff. So they're going to be like, ooh, premium. You're going to be paying $500 a month. Obviously, probably not that much, but something crazy.
It could be that, actually. It could.
Yeah, so that's what I'm saying. Just go now. And then, so besides, I know, the doctor stuff, I know you touched on it briefly, hey, there's different type of, requirements that I have. What is some ones that people won't know, like myself, you'll have to do besides, go get an evaluation?
Well, you don't always have to, getting life insurance for young individuals is pretty easy. Most of the times, you don't even have to go through an exam. You don't have to go to the doctors for anything. Depends on what they find in the health history. If they find, because they pretty much pull all your records, basically. They talk to your doctor. They look at their records. They look at any history that you had. They ask you questions about if you had asthma. How long did you have asthma for? What do you have to take for that? I'm not even sure what other illnesses there are out there. But,
yeah. Well, okay.
So they go through a whole analysis. So if you're someone that don't have any illnesses and you was pretty much healthy throughout your whole life and you're young, 10 out of 10 times you don't even have to do a exam.
Verbal?
Exam or evaluation, and then it's pretty easy. But yeah, definitely want to make sure that you're getting that as young as possible, even at least a term, and then like I said, just convert it over into a permanent policy, because you never know when is your time.
Yep, exactly. So all the knowledge you gave us was some gems that I think obviously they don't even teach you this in school. They don't teach you this at all anywhere. I don't think I ever heard of life insurance. Obviously, the only place that I heard of life insurance was in the Marine Corps, because our type of job. All right, everybody's getting life insurance because you never know. But when I was working regularly, some places don't even offer benefits for your job anyways. You got to be lucky to get life insurance, but they don't even say all right, we have all these benefits. They just pretty much say, hey, here's the benefits package. Let us know what you want. They don't really explain it. They give you the quick description and stuff, and it's up to you to really determine and find out the information, and you physically have to ask them hey, can you explain the life insurance policy? But most of the time they give you hey, welcome. Here's your you do your interview. Hey, here's our policy. Fill out what you want. Do you want the 401ks? Do you want all this stuff? Life insurance, we offer that. But some jobs don't. So you might have to find out yourself. And obviously, if they don't teach you about it, you don't talk about it anywhere, it go right over your head. And then before you know it, you're 60 years old. Oh man, I'm getting sick. I don't even have life insurance. So now you're trying to get in. And I think that's how they get you.
Yeah, when it comes to also too, glad that you mentioned that, because when it comes to the life insurance that our jobs provide, most of the times it's not even enough to cover everything that, all the needs that I mentioned earlier in the podcast and earlier in the episode when I'm talking about the funeral costs, talking about any debt that you left behind. Let's say you wanted to put your kid through college or any other type of goal that you had. Transitional income replacement as well. Your job probably covers at most, I say 50,000 at most, which is
so they don't have that big 500 for
Oh no
figure type of value.
No, not at all. Probably at most, I know for my job is 10,000.
Okay.
So definitely want to make sure that you're getting aside. You're gonna always keep your insurance from your job and get your own policy privately. So definitely want to make sure that you're doing that. And
Okay, so that was a good one right there. Because even I was like, maybe it just I don't think besides the Marine Corps, but that's a special case where they got life insurance. But most places I didn't know because I was like, I never really took the life insurance thing. I was young, I worked for a little bit, but I didn't know. I thought it was like, hey, they have life insurance and I can get up to the whatever the max is. I thought it would be at least 6 figures. They're like, getting like 10, 50 max.
50 max, yeah. But so another thing about life insurance through your job is that it doesn't build cash value either. So pretty much is just basically term insurance.
So it's just something quick, like you were with the company, thank you, we're sorry for your loss. Here's a check for 10 grand, which I think pretty much what they in my
cover
opinion,
the funeral.
Yeah, it'll cover like, hey, if they work, I think jobs offer it as like a safety net, like, hey, here's something to cover your expenses. I think that's why, like 10 grand, like, hey, if they will cover that. It's like almost still paying you over time. So I'm pretty sure that's why it's so low. I thought it was a lot higher.
Not at all. But yeah, it's pretty much term insurance. If you were to leave the job, then the policy ends pretty much. Most of the times it ends, but I know there's some occasions where you can actually keep the life insurance and keep paying the premiums. But still, overall, it's just still pretty low insurance coverage, and it's not pretty much gonna
so if you
find your needs.
So I think that'll probably be a good one for everyone out there. Like, yeah, my job I know I got life insurance on my job, but find out how much it is, and then when you find out,
I get that all the time.
Yeah.
Oh, I have my
life job got life insurance. Okay, how much is it? You're like, oh, how much is it? Huh? Let me find out. And then when you turn that page and it say $8 grand.
$8 grand. Yeah, it could be something low like that.
Oh, snap. I really need to get some real life insurance, because you just thinking right now you're going on with your day like, yeah, I got life insurance. I know I'm good, but you might want to go in and find out how much the value is, what's the the term and everything like that, how it works.
Yeah. Also, too, another thing is that I get a lot of my mom took out a life insurance policy for me, but a lot of people don't know that policy probably ended like years ago. You didn't even and your mom never checked on it, and it probably just ended. And now you think you have life insurance, but you don't have life insurance.
Okay, so that's good thing about that topic. So you can take out a policy for for pretty much anyone, and what is that? That means you're just paying their premium already.
Yeah, so you're paying a premium. So most of the times when it comes to when a lot of people are saying, I already have life insurance, my mom took a life insurance policy for me, they're probably talking about riders. So when it comes to like a life insurance, you get add like child riders, where basically they'll be covered in the event that they passed away. The policy owner, which is the mom, they'll receive the 500 or. Yeah. Nah, usually it's not even 500,000. It's like 50. Yeah, 50,000 is probably the most that you could add as a rider. But pretty much your mom would take out a policy and then she'll add like her kids as riders. So it'll be like 50,000 each for each kid. And you can.
But she has to pay for that premium.
Yeah. Pay. It's all like bundled up in one premium.
So just raise the premium up.
Yeah, exactly. So. Okay. But that ends after like you're like 18 years old.
Okay.
So it's pretty much like term insurance as well, because it has an end date. Now you can convert that into your own policy, but most people aren't aware of that, so they think that they have life insurance when they really don't.
Yeah, because trust me, you don't want to be in that situation where you think you got life insurance and then they tell you, sorry, Mr. Johnson, your life insurance policy been canceled since you were 17.
Yeah,
and then
exactly.
Now you're stuck. And it's obviously the best thing we can tell anyone right now is if you think you got it, just double check. See what your numbers are. See how long it is. See what type of policy. See who it's through. A lot of people don't even know. Like, hey, you work at like a bank or something. They offer you life insurance. You think Capital One. I got Capital One life insurance. It's not through Capital One. It's through somebody else, pretty much.
But yeah, you can definitely take out life insurance policies for someone else. You just have to have something called insurable interest. So, for example, if you wanted to take out a life insurance policy for your mom, you can do that because you have insurable interest, meaning that if they passed away, you'll be negatively affected by that.
Oh, okay. So you can't
You
just take
can't-
it on
from a random
my
person.
boy. Yeah, he like,
you
yo.
Yeah, you have to prove that you'll be negatively affected by that loss. You can't take it out for, like, let's say you seen an old lady walking down the street and you was like, oh, let me talk to her, see if I could like take out a life insurance policy, and then when she passes away in 3 years, I'll receive $500,000.
Yeah. So you can't. They're like, oh no.
Nah, you can't do that. You have to like have insurable interest, meaning that if she passed away, you'll be negatively affected by that, which you won't, because she's a stranger. She don't even know you. So
Okay,
you could
so
do
you
that.
can't finesse the system.
Yeah, you could. Yeah, you can. I mean, there probably is some ways where you can finesse it. I just don't know. But if you do, hit me up. But yeah, you could do that for your mom. Because obviously, if she passes away, it's most
You're gonna be on most of the
more
bills gonna
times
come
than not, you
yeah,
have to
the
be in
kids.
charge of the funeral.
Yeah.
Funeral costs, probably like, her debt that she left behind. So pretty much you and your siblings will be taking care of whatever she left behind.
All right, I hope my mom heard that because I'm coming for that 50.
Yeah. So pretty much you just have to talk with your mom and say, hey, I'm thinking about taking a life insurance policy out on you, because obviously when you pass away, these things will be left to us and my brothers and sisters, and we want to make sure that we're in a good position.
Okay, so when you say that, I think you mentioned, is it like a term, or can I take out a permanent, like my mom, like maybe she do and end up living for another 40 years or something like that? Are they gonna be like, oh no, you got to renew that, or is it like every 10 years or something like that?
So you saying like can you take on a term policy?
Or just take out so when I'm taking out a policy like under a family member or something like that, are they gonna tell me it's only from today's date to like 10 years from now? Or are they gonna be like, I want to do it to the.
I'm pretty sure you could do a both. Yeah, you could do either a term policy or you could do a permanent policy. But pretty much the main thing that you need is just that insurable interest.
Okay.
Because like I said, you can't take it on like on a random person. But and also they need to give you permission to do that.
Okay. So I just can't be like,
yeah,
yo, ma, took out life insurance policy. How you good luck?
Yeah. Nah. She has to like write a letter or like giving you authorization that it is to the insurance company that it is all right. But yeah, so I know I've heard in like other podcasts where you can actually take it out on your friends. I think I've heard that before, but I'm not really too knowledgeable about that area. But if you can do that, definitely do your research, because that's pretty much money that once everyone's gonna pass away. Yeah. So if you could take on a life insurance policy on someone and when they pass away, and they name you the beneficiary, then that's money that you could like pay their funeral expenses, so your family doesn't have to so their family doesn't have to come out of pocket for that. And you can also give a lump sum of money to their family for their grieving process, and also just keep some for yourself as well. So
about to be a bunch of people on here talking about, yo, I just took out policies.
Yeah.
for X, Y, Z now, but yeah.
Yeah, it's just a great life insurance, just a great way to build wealth and just create that for like the next generation. Next generation is very slept on. It's a very slept on topic, but that's why we're here to educate you, to spark your mind on, just try to get into these different areas of finances, because
and if obviously we're gonna have a lot of different topics on a lot of stuff, but I think life insurance is the main, like the first step to becoming financially free. It can help you obviously if you do like the cash value, but it'll do the generational wealth portion. It will skyrocket you. You just imagine like when it's your time to go, your kids don't have to start where you just started, or even family, sister, brother, mother, if like I can help them, they already can start with 6 figures or something, and that'll pay off all your stuff pretty much, and they'll have so much left over that they can actually move forward, pay their bills. They don't have to invest exactly to actually do stuff with it.
Yeah. So like that's pretty much how you're gonna build that generational wealth. Because if for example, I have a $500,000 policy. If I do pass away before I have kids, they'll go to my 2 sisters. So that's $250 each, pretty much. So they could use that $250. My sister could use it to pay off her mortgages. now she has like, a couple properties, so that's pretty much income, just rental income coming in, without having to pay a mortgage. Then she can also use that to buy another rental property or invest it in the stock market, invest in mutual funds, maybe start a business, and then she could do that for her, take another policy for her kids, and just keep repeating that cycle.
Yeah,
they could keep
pay school bills off. You don't have to worry. Your kids won't, like something happened to you before, as we mentioned, we talked about it earlier, but you want your kids to go to college, and if you go away before that happens, hey, at least you can sleep peacefully, like, all right, my kids can, no matter how long it takes them to go to school, I'll put enough into my life insurance to pay 18 years worth of a lifetime.
Absolutely. So yeah, man, there you have it. I hope you guys really gained a lot of knowledge when it comes to this one area, because it is, like I mentioned, a slept on topic, as well as a topic with a lot of misconceptions. So definitely do your homework, do your research, do your due diligence. Go out, get a life insurance policy, and yeah, I'm glad we could educate and empower you guys.
That's a fact. Flipping Finance, we out.
Yes, sir.